Good evening to all of you. Welcome you to today's webinar. Today we are going to discuss on open interest and also how the open interest can be a support and resistance point, and also how do we choose the strike for a credit put spread. So these are the 2 points, two major headlines that we are going to discuss today. Now this open interest, we have had webinars before. So we are trying to reiterate how effectively you can use this open interest. Now everybody is aware of price, then time, volume, because what happens in the market is basically now dependent on all these factors, right? Sorry. So here we are looking at the price, volume, time. So generally we know that if the price breaks out with good volume, it is considered to be bullish. So this is the normal technical indicator that is used. Any breakout, price breakout with good volume is considered to be bullish. But if there is a price breakout without a volume backup, that is volume is not good, then in that case it is that particular bullishness is suspect. That means whether that will maintain that momentum or not will become doubtful. So we need a good breakout and breakout with volume, and also we should not end up doing a breakout after the price has rallied significantly. Let us say Nifty has rallied now back to its previous high of 17,900, 800 or so, and then 18,800 or so, and then it again starts breaking out with good volume. Then probably there's a chance that there could be some distribution coming. So you must try to understand where the accumulation takes place and where the distribution takes place. So after a significant rally, if there is still a price rally with good volume, good chance that probably the distribution is likely to take place. But if there is a good amount of breakout at a lower level, and with good volume support, then in that case that momentum will be maintained. So we have to understand the price volume action in terms of how far the price is also rallied, because there's no point after a 1,000-point rally in Nifty from a bottom, you end up with good volume. Then probably the strong hands are not coming. Like strong hands will come at lower levels, like today. Okay, today because there is a correction that has taken place till Friday, and today the price at least broke the Friday high. So if it is with good volume, then in that case you can really expect the momentum to sustain. So the price volume action is very important. Of course the time is also very important, but the volume is nothing but the transactions that takes place. Like so I buy 100 shares, and so the volume is considered to be 100 shares or 100 lots. Okay. Now in the case of an open interest, what you do is that all the outstanding positions which are not squared, which are still pending to be squared, is called the open interest. So that means, let us say all the longs, either you add all the longs or you add all the shorts. So you get one of this, then that is called the open interest. That means, let us say today I do 10 shares, okay, or 10 contracts. Then again tomorrow, so somebody, if I'm buying and somebody sells, okay, that is also 10. So let's keep it like this. So I buy 10 contracts, somebody sells 10 contracts. So the open interest becomes 10 because there is the outstanding position. Like, so tomorrow somebody comes 5 and 5, a new buyer comes, new seller comes. So the outstanding is now 15, right? So now, assuming that the transactions get reversed at some stage, now I become a seller, 15 contracts, and somebody has to buy that 15 contracts, right? So then outstanding becomes 0. The outstanding open interest will become 0 because there is no outstanding position right now. So there should be an outstanding position. So the net long or the net short positions are generally considered to be the open interest in the market. Okay. So what does that open interest help us to understand? There are a lot of transactions because in options we have seen there are multiple strikes. In the futures, you buy at the present futures price or you sell at the present futures price. But whereas in the case of an option, you have a whole range of strike prices, which is some 1,000 to 1,000 points lower from where the market trades right now. And similarly in the upside, for example, let's say right now 17,800 or whatever it is, 17,900. Then you have, for every 50 rupees or 100 rupees in the case of Bank Nifty, you will have the strikes, right, from 17,850. Then it goes down and it can even go to 16,500 or so, right? So there are multiple. Similarly on the upside also, you got something like from 17,950, maybe it will go at 19,000 or so, whatever it is. So okay, so you have got multiple strikes on which you can buy an option or you can sell an option. Okay, so in whichever strike you have the maximum open interest, that will indicate a chance of a support or resistance at that particular levels approximately. Now let us say the open interest means let us say now it's at 17,900, and let us say this week expiry, let us say 17,800, then 17,700, 17,500. Okay, let's say these are puts. Okay, and let us see in which strike the maximum open interest, that is maximum net short or net long position exists presently. Okay, now that will indicate a probable area of support. Now the reason is, see, normally options sellers are considered to be experienced traders or professionals or institutions. Normally the buyers are considered to be retail. Now it requires a lot of courage, it requires some investment also to go for selling a call or selling a put. So the big ants, if they sell a put, that is, if the open interest is very high in a particular strike, then that means you can say that the sellers of the put probably they know very well that it is unlikely to go below that level. Because why do you sell a put? You sell a put because you think the market is going to go up. So we have a view, and the view is that it is likely to Nifty is likely to go up. In that case, you have got three choices. One is buy a futures, one is buy a call, or you sell a put on the basic sides. Okay. Now, if you look at the open interest, let us say somebody buys a call, probably they feel that the premium that they pay probably will not be there will be decay, and so they don't. If there is even a let us say you pay 100 rupees for this week expiry, and even if the price collapses a little bit to 100 rupees from 17,900 to 17,800, you lose that amount, right? But whereas let us say you do a 17,500 sell put, I'm not at this point of time talking about margins also. I'm only saying that if you sell a 17,500 put, even if there is a dip or decline, the view that you take is 17,500 may not be broken. So that's the view that you take. So you sell a put basically at 17,500. So you take a sell put at 17,500. Now let us say that comes to 39 rupees or so, and you also expect that probably from here, let us say the rally could be up to 18,100 or so. So if you have a view that probably it can be 18,100 or so. Okay, so let us say now it's 17,900. Okay, so 17,500 put is, let us say it goes at 35 rupees or 40 rupees or so. So there is a chance that you may feel that let me say I will sell 5 puts. Of course, I'm not coming to the margin side, whether it's efficient or not, I'm not coming to that. So now you buy a futures, it goes up to 18,100. So you make 200 rupees profit. You sell a 17,500 put 4 times. That's the risk that you're taking. 40 into 5, 200. So you're also getting the same price. You're also getting into the same thing. Now, in the case of a futures, let us say from 17,900 to 17,700, you lose on the futures, right? 200 rupees you lose on the futures. 200 rupees. But whereas still 17,500 is not breached on the put side, you retain that 40 rupees per contract into 5, 200 rupees. So you have a expectation that 17,000, even if there is a dip also, it is not going to go below 17,500. And you also feel that probably the rally from here is unlikely to be more than 18,100. So you go for selling that much of quantity, right? So that is the view that you take. And so that comes by adding some contracts on the short side, which will keep increasing the open interest. So that means that open interest which keeps added to that particular strike indicates that the big players are thinking that this level will not be breached. So that becomes, suppose a fall closer to that particular place will indicate that there is a good amount of support that is likely to come closer to 17,500. So that is as far as the sell put is concerned, right? So similarly, if you do a sell call, okay, sell call means that you're taking on the reverse side that probably the chances it can fall, market can fall, okay, and if it falls, it will also fall to certain levels. It doesn't matter for you because only thing you don't want an upside. So you take a strike where even if there is an upside, it will not breach that particular level. So we have to see in which particular strikes normally the open interest is there, and in which strike you see also the open interest gets added. That is the change in the open interest. So one is the open interest by itself, then again is the change in open interest. So one is the open interest, and also look for the change in open interest every day. So that will also indicate that which direction, which way it's moving. Suppose if there are more contracts added on the open interest keeps on adding on the for a call side, that means they expect that it will not go much below above that. Okay, so the addition of open interest probably indicates that's an important area of resistance levels. Having said that, be careful that it's the big hands. What they will do is that is the reason why you see prices flaring up. See, that's one important reason why sometimes on a particular breakout of a particular level, you just see the momentum just like that coming, right? A momentum just flaring up, so to say. That is because now they realize that there is a threat to that position, threat to that strike. So what they do is they cut that position, reduce the open interest, and shift it to some other levels. So normally the option traders, what they will do is, if they feel that that particular level is being reached or a particular technical level is being broken, they will cut that existing risky position and roll it over to some other strike, or roll it over to some other expiry. So that will indicate, that probably they are losing out on the present area of resistance which they expected, but they are still hopeful that a higher level will not be breached, and that is why they are rolling over the position. Okay, that is why they are rolling over the position. So we will look at the when we look at the open interest, you will now understand that one is that in which strikes presently the open interest is the maximum. So that will give, if it is in the put side, that will give an indication that is going to be an important support. Similarly, on the call side, whichever open interest is higher, that will give it some area of resistances. Okay, and also we must also understand that normally you will get this higher open interest always in important rounding of positions. Like for example, if the price is 17,900, you can see a lot of open interest building at 18,000. It will come closer to 18,500. Then it will come closer to 17,500. So that is how generally the traders put it. In between they put, because the liquidity is more in the 500 contract, or in the 100 contract also. For nearby there will be liquidity, but generally when speaking, normally if you want to take less risk, okay, if you want to take less risk, even if it means that you are going to earn less, so there will be a lot of people, what the traders will be doing, let me earn less but let it be safe. Okay, the yield on the investment that I'm putting could be less, but it should be safe. Okay, so that could be the concept. So probably they will be looking at 17,500 sell put, 18,500 call, because these within this particular V may not be easily achievable. Now probably it is possible that by month end it could happen. So what they will do is they will adjust the strike. So once the price starts moving up above certain important technical levels, probably you can see that particular strikes being cut and being rolled over. So that will give an indication that a cut in the open interest probably is now giving a feeling, that is probably the cut, that is the open interest starts reducing in one particular strike, then that particular resistance, now they are fearful that probably that level will be broken. So that will also give you a good indication of how to look at the market from the point of support and resistances. Now let us look at some illustrations in Nifty itself, which will give you some thoughts about of how to, and also the caveat is But see, these are all everything, whether you do a technical indicator, statistical, or open interest analysis for options, all these things will give you some idea. See, market is supreme, and there can always be fluctuations up and down, fluctuations up and down. Some areas which we consider the important resistance support may get broken and all those things. So I think we'll not look at it as if it's a very sanctified place. And if 17,500 is the open interest, highest open interest today, that does not mean that 17,500 forever in doing this experiment will happen. That is, as things stand today, which are the areas of support and resistances which we have already looked from the chart point of view, but which is that what we are looking from the open interest point of view. So first we will look at the chart, then we will look at the open interest, and that will give you a fair indication of the important support and resistance. So we go to the charts here. First, so today is the today's Nifty, right? So now what happens here? See, today it started to move up above this particular high, which is 17,915, which probably indicates that this is going to be some important support. 17,610 or 600 is going to be a very important support based on the break that has taken place here. Now we have got how many days? We have only 2 days to expiry. November 3rd. I think Wednesday is the expiry because Thursday we are not working. Thursday, Friday, I think. So Thursday is the expiry. So Thursday working is not there. So Wednesday is the expiry. So that means 17,600. There should be a good open interest because now this is broken. So general expectation probably is that 17,600 will not be broken. So the what will you do? That means you will buy now in the suppose. So when we say that, the chance that you can go for a buy of the futures, right? Then there is another chance that probably you can go for a sell put at 17,600. You can also look at 17,500 sell put. You can also look at some sell credit spread, okay, sell put spread, keeping 17,600 not being likely to be broken. 17,700, 17,600 put spread also you may try possibly, okay. So based on this, the open interest will gyrate. Now let us look at what has happened with respect to the open interest. Now at the same time, when we look at the resistance, so these are the resistance points, right? So this particular area where see this particular low or close, the close is 18,114 and this is 18,125. So closer to 18,100. So 18,100 probably could look to be a resistance as far as this close is concerned. So what is it, the expectation right now from the chart? It could be between 17.6 and 18.1. 17.6 to 18.1 is the expectation. So what they will do is, for 18,000, if they get enough premium which will cover a risk up to 18,100, that means let us say you sell a 18,000 call and you get something like 100 rupees, then you presume that you are going to be safe till 18,100 is crossed. So if 18,100 is likely to be crossed, probably they will cut that position and roll it over to another position. So, or if they, because 18,100 is the important resistance level right now, right? So if 18,100 is crossed, there could be a change in the open interest position. So let us look now. We having looked at the chart. So let us look at the open interest from what's happening with respect to the open interest support resistance points. Now from the chart basis, it is 17,600. So, but 17,600 means normally in the case of an option sellers, what they will do is that they may not go for 17,600. They could probably look at 17,500 in order to make themselves a little more safe. That will depend on the option expiry time, because if I take a 17,500 for this particular week itself, maybe for 2 days, with the price trading at 17,900, the amount of premium that I'm going to get is going to be low. So what probably they could do is, okay, let's not look at this option. Let us look at next week, because anyway I got some intervening holidays also coming. So there's chance that probably the entire focus could be shifting towards the next week also. Okay. So let us look at what's happening in the open interest picture. Now we go to the NSE CD option chain. So this is the option chain, and I am unable to change the background color. So kindly bear with me, I'll read it out for you. So now this is 11th November. I've just not taken this particular week. I've taken 11th November. So let's look at what's happening with respect to the 11th November case of how the open interest is now looking at it. Now we are closer to the 17,900, 950 levels as far as the, or we are closer between 17,950 or 18,000, right? So 18,000, this on the call side, if you go to the NSE option side, you put the NSE option chain. So you'll have open interest call side one and open interest put side one. So let's look at what's happening with respect to the call and put. On a balance, if you see today in the Nifty is 12,940 contracts. 12,940 is the open interest as far as 18,000 is concerned. As far as the call is concerned, it is 12,940 and 18,200. Now 18,200 is going at the maximum level. That is to 18,200 is now going at a level of 13,974. The maximum open interest is around 18,200. 18,200. And also if you look at it, the addition of contracts, open interest is the highest at 18,200. If you just go through the NHC option side, today the open interest, the highest at right now for next week stands at 18,200, and after that it goes to 18,500. So 18,200 is giving a picture that it is around 13,974 is open interest as far as call is concerned, and 5,980 contracts have been added today. So that means I think they are still, as far as the expectation is that 18,200 may not be broken, and even if it is going to be broken, they are getting 107 rupees as a premium. So what is the break even? 18,300. So the general thing is now 18,200 is the this one, for which 105 rupees is the premium. If you sell a call, 18,305. So the break even is 18,305. So their view is that it will not cross 18,305 because right now it is almost you got 350 rupees at least. You got 350 rupees. 350 rupees. And why is it that probably it is high? I tell you why. Now, this is where you have to choose the strikes. That's what I told you about the credit put spread, the choosing of strike. Now, the 17,950 approximately 18,000 levels. Now, if you look at it, 189 rupees is the call price, 174 rupees is the put price. So, let's add both of them. Approximately 350, 360 rupees it comes, right? So, 18,000 plus 350, 360 is 18,360. So, general opinion is the straddles. Now, that means you buy a straddle. Normally, the expectation the straddle will not make a profit. So, that's the view that generally when you pay a premium, you end up losing. So the sellers have generally won over a period of time. So that does not mean that you have to do that. So that's a different thing of point for discussion. But you add a call and put price in a particular strike and take, which is at the ATM strike, which is close to the ATM strike. If you take, the general impression is that probably you may not get a profit. So what you do is that there is approximately this 350 rupees it comes. So you go for 18,300. Normally you should have gone for 18,300 call sell, which is closer to the 77 rupees. But there is a general feeling that 18,300. So I am telling you because there is only a 15% chance that it's going to be above 18,300, as indicated by the open interest. So what they are doing is they are selling 18,200 call and trying to maximize the profit by taking 100 rupees the premium. So it comes to 18,300, which they feel will not be broken. So that is what the open end. So there is a chance that if there is going to be successive rise, then probably they may cut it, roll it, and roll themselves over to a higher position. So that is as far as the call position is concerned. Now let's look at the put. Now put right now going by the same logic. Now let's say where the put thing is. So it is coming closer to 17,500. I think right now. I think the open interest is maximum closer to the 17,500, where you got something like 10,600 contracts. 10,600 contracts is the maximum on the lower side, which means that, as I told you, 17,950 here, and it's approximately 350 rupees if you add the 17,000, 18,000 call and put approximately. So it comes closer to the 300 rupees. And 189 plus 174, 350, 360 rupees, right? So 350 and 360 rupees. And presently the market is, the Nifty is 17,930. Okay, 17,930 is the spot. So 17,930, what they do is they add probably the 350, 360 rupees. So 17,930 now plus minus 350. 17,580. So it is 17,600, let's say approximately. So 17,600 should have carried the maximum open interest, but they are putting at 17,500 for the safer sake. So 17,600 minus 53 rupees if you take. So normally that should not be broken. 17,600, you get a 53 rupees thing. So it comes to 17,550. So since 17,550, now they are taking a chance with 17,500. So even if the Nifty is going to drop below 17.7 to 17.6, okay, 17.7 to 17.5 or so, 17.6 to 17.5 that band, very highly likely chance that it can bounce from that level and come back. So that is the reason why we are seeing 17,500. And today, if you see in this particular case, the maximum amount of open interest has been added in only these two places, 17.5 and 17.6. So 17.6, if you see, almost matching the 17.5 as far as the open interest is concerned. So which means clearly that probably, because of the rally, the open interest is now will keep getting added more at 17.6 because the option price at 17.5 after some time will dip. So there is no point in adding much on 17.5 as days go. So it will then progressively become, for every 100 rupees rally, it can shift back to 17.6, 17.7, all those things. So right now it is a very clear case that this open interest looks that 17.500 to 17.600 to 17.500 will be a very strong support on a close basis. That is, on this one it can break, but on a close basis 17.5 to 17.6 is expected to be a strong support, and 18.2 to 18.3 is expected to be a strong resistance level. That is what this open interest for the next week option is looking at. So so that means this is support and resistance for till next week. This is the support and resistance. Probably it is expecting till next week. Now, if you look at the same thing for the month end, so we'll go to the 25th. So 25th, now approximately closer to the futures is closer to 18,000 levels. 17,929 is the spot price. 17,950 to 18,000 approximately is where the futures price is. So the 18,000 call put is approximately 295 plus 270. So which means this is 300. 560, 550. This is approximately 550 rupees or so, right? 294 plus 270. So it comes to around 560 rupees. So generally speaking, that's 560 rupees you take. 18,000 minus 560. It will come closer to 17,400 or so, right? So 17,400 levels. So probably we could expect the support on a close basis for this particular month could be 17,400. That's what this is indicating, right? So you're adding another 550 to 600 points. Similarly, on the upside, it should be closer to 18,500. So let's look at the open interest on the upside. If you look at it, the maximum open interest in the upside is coming closer to right now. Of course, after the 18,000, there is something which is getting probably we have to see what happens. But after that is the 18,500. 18,500, almost neck and neck. It's going with 18,000. So 18,500, we have seen 2,957 calls also being added, and the lower level are being cut. If you see, there is an open interest decline in 18,200, and also 18,300 also is showing decline, right? 18,350, all those showing a decline. So where the addition is coming, more additions are coming in higher strikes is the 18,500. So this 18,500 looks to can be a strong resistance based on the option premiums. Right now, what it is suggesting looks to be 18,500, because at 18,500, if you sell, you get 108 rupees. Okay, 108 rupees, which means 18,608 or 650, which is very closer to the present peak. So that is why a lot of open interest resistance area is coming closer to the 18,500. Now, if you look at the bottom side, see, look at this. Okay, 17.4 has got an open interest, which is this, and 17.5. So 17.4, 17.5. So this is the area which is also being shown. And if you see the open interest here today, there is a drop in open interest at 17.4. That means they are chopping off 17.4 and they have moved themselves to 17.5. You see, because the 17.4 has been cut, open interest has declined. That means number of sellers who are there has declined, but it has got added to the 17.5. It has got added to 17.5. So that means there is a great interest as far as 17.5 is concerned, which is very clearly indicated from the weekly option as well as the monthly option, that 17.5 is likely to be a very important support, and you're getting 108 rupees there also. So this is a place where 108 rupees you're getting 17.5, and also we have seen the 18.5 also giving something like 108 rupees. So that means if you are bullish on the market, you sell 17.5. So you get a feeling that probably below 17.4 it will not go, because that's a break-even place. And the 17.4 also represents what I told you is 550-560 points below from the present spot price, which means they consider that to be quite a safe area to go for a sell. So the very clear indication from what we are getting right now is 17,475, 17,500 on a monthly basis could be the important support zones. It can dip below that, but on a close basis it is going to be above that. Similarly, the expectation is that even if it goes above 18.5, it can be below 18.5 as far as the this month is concerned. But as far as this, I want to strike as a matter of caution. Now, in a bull market, there is a chance that this resistance which they are talking can be broken. So that is what we have seen in a bull market. Successive resistance are broken, and supports have generally held, except one or two supports. Supports have generally held. And today, yesterday's Friday's decline was also closer to the 50 moving average. So from there it has taken support. So now if it starts to move above the 18,100 levels, which is what we have marked as an area of resistance based on the price action, then there's a good chance that probably we can look as if the correction is over, or probably the correction itself is forming more amount of consolidation. It could rally back to 18.6, 18.7, then dip, or probably you can expect that even the 18.6, 18.7 will be scaled comfortably. So we don't know. Only thing is, 18,100 break will indicate that probably the area of 17.7 which came, or 17.6 which came, could be a very, very important amount of support zone. So very clearly, in that particular case, if 18.1 is broken, you can see definitely 17.5, 17.6, 17.7, where the open interest will get added, and successive things will show you that where probably the price, even if it breaks down, will climb back. So if that be the case, then in that case we should also look towards selling put closer to that particular place, right? But only thing is for us is that the fear that in case if it starts falling, then we will be in trouble. So what we should do is that we should do a spread. Okay. Now we identified very clearly that in this particular week also 17.6 is unlikely to be broken. So what you can do is you can sell a 17.6 put and buy a 17.4 put or so, in order to reduce your tension as well as to make some decent money instead of huge money. Now let's look at this the coming week, 11th November. So the 17.6, if you look at it, you're getting 52 rupees, and you just buy a 17.4 put. So you will get 50, that is 20 rupees. So put together you get something like 52 minus I think 17.4 is this 26, I think 26. So that's the last traded price. So 26, and this is 17.6 is 52. So you get 26 rupees. For a 200 rupees dress, you are getting something like 26 rupees. So if there is going to be a bigger fall, then at least you are protected to some extent. But this 26 rupees, if you consistently get, you will definitely get most of the times. Most of the times, your chances that you will get that particular price. So this 26 rupees you keep adding, and probably over a period of time, chances that you will make money loss is going to be less. So instead of now, why the reason we are doing a buy is that probably we are trying to reduce the margin. In this case, now we are clearly coming that one is risk addressal. So however much having said that 17.6 is an unlikely level to be broken, or even if it is broken, the good chance that by the 11th expiry, it will be above 11.6. But there will always be some back of the mind of saying that what happens if the situation deteriorates because of some reason. We have seen even this month itself, after a huge rally, it has corrected by 1,000 points from 18.6 to 17.6. So how do we know that probably it will not correct lower? So for that risk addressal, you do a spread. So that spread will take care of your risk. Second point is that it also takes care of your margin. Okay, so because when you go for that, your margin comes down substantially. So here, which we have already said before, so if you do a 17.6, 17.4, then you have a so you get a 2% on the value of the contract, which just comes maybe to 17,000 rupees as exposure margin. Plus they will take 200 rupees as a risk factor for this. I think so 200 into 50 minus you get 27, because you get 26 rupees also as the premium. So if you do this 174 into 50, maybe some 8,000 rupees or so. So 8,000, so maybe it will come to 25k, right? So for a 25,000 rupees investment, you can do a spread. So if it works out well, you get 26 rupees or 25 rupees into 50,000, 250. 1,250 on a week of 25,000 rupees is an excellent return that you will get. So based on this particular calculation only, they do it. So that is why we see the open interest, why it is going up at that particular level is probably there will be some pure short sellers also, because institutions may not, they have the resources, they are not bothered, maybe they may not have much of a margin problem, and probably they know how to manage the existing positions in case if the risk is there, so they know how to cut the positions, or they have the system to do all those things. So probably there could be plain sellers of those particular strikes. But for us, we need to be very careful, because we need to know that our margins have to be less. We should be protected in the event of a black swan, which they call as a tail end risk. So if that happens, then we should be protected. For all those things, it is better to do a spread, where one leg is a sell, another leg is the buy. Okay, and to extract some premium and to pay less margin, just leave the trade, and you don't need to do anything for this week. No for stop loss, nothing. If you want, you can cut the position and do it, but that will depend on whether it's going to fall below 17.5 or so, those cases. So you can just leave the trade and do it. So that is how you look at this, look at these positions and manage it, right? So the same thing you can look at the bank Nifty also. So let's look at the bank Nifty. So bank Nifty 11th November. Now it is closer to the 39,900 or so. So what's happening is it's coming 275 into 2, it's approximately 550 rupees. So you should get something like 35,500 and 40,500. So 39,500 and 40,500 for coming for the 11th week. So 39,500 if you see is around 95 rupees, 92 rupees. And if you see the open interest is a maximum around that level. Now you can see it is on 49,037. 49,037, and the next one comes at 38,000, 39,000. So in bank Nifty, as I told you, there's a round up figure which is more than the 500 levels than on the 100 levels. But incidentally, the option prices which are right now with us also indicate, because we have added the as if like a straddle, we have added the buy call and buy put price, which comes closer to the 550 marks. Okay, so now price is closer to 40,000, so 500 marks comes closer to the 39,500. So 39,500 is looked to be a very good important area where the open interest is high. And if you see today, the open interest maximum change in the open interest is also the maximum is going around the 39,500 levels. So this means the open interest is high and change in open interest is also very high, which means more amount of short sellers of that particular put have come closer to the 39,500, which indicates a very important support level coming for next week. Again, I tell you, this doesn't mean that it will not change. It will change if the traders' view and the market perceptions changes at any point of time. But at this time, it shows that this can be a very important level of support. Similarly, if you go to the straight away here, if you look at it, 40,500 is carrying the maximum interest, open interest. But one thing, if you see, there is not much of a change in the open interest. So open interest has got reduced. In fact, the open interest has got reduced at the 40,500, which means that probably they are just trying to roll over. Now, if you see 40,600, 40,700, 40,900, they have added open interest. They have added open interest right now, which means what was lower at that point of time now is getting added, which means that these 40,500 traders are a little bit fearful that it can come, because if you see the open interest, change in open interest, this change in open interest indicates that there is a cutoff of the short calls. There is a cutoff of short calls, and also if you look at the this figure, which is the 41,000, I think. No, this is, yeah, this is 41,000. Even in 41,000, there is a cut in the open interest. There is a cut in the open interest. To some extent, other areas have got added, but if you see, there seems to be even higher levels are getting slightly jittery, with number of this one getting cut. But whereas in the case of open interest in put, it is being added, which means very clear indication that Bank Nifty probably those who are on the short side of the market are a little bit afraid, a little bit fearful, and that's what is indicated. That means chances that yes, the market can flap. That gives you a confidence for you to go long in Bank Nifty or the index or whatever way you want to express your opinion. So let's look at the chart as far as Bank Nifty is concerned, and let's see whether that it confirms that. So this is today's action, and if you see, it has crossed this particular high, that means probably yesterday's Friday's high has been cut, which indicates this is a strong support. Which indicates this is a strong support, because it has come to a very important support. And right now, that day itself there was a pullback, and today it has now opened much within the higher in the particular bar, and it has started to go above that particular day's high, which means 39,775 has been cut. And we indicated that probably we need to wait and see whether this close is taken off, which is the 39,518 or so. Now that has been taken off. So maybe there is some resistance closer to 40,000, and there was some pullback closer to that level. But anyway, that it looks as if that may be crossed. So probably it is heading at least to some higher level, if not to this, but probably it could be heading back to these particular levels, which is 40,500. 40,500. So very clearly, even that 40,500 is getting some sort of jitteriness for those who want to be on the short side. So we have seen that a lot of people, interest being cut, open interest being cut of 40,500, which itself indicates that probably there could be good amount of rally still coming. So it's a place where probably we can look towards more of a sell put, which is 38,500, because 38,426 is the support taken in the chart, 38,500. Now it has crossed this particular level, which is the 39,763. So 38,500, I don't know whether it will yield any price for this week. Let's look at it. Because it has been quite volatile, 38,500 is hardly 18 rupees. It's hardly 18 rupees. Of course, even in there, some open interest has got added. In that case, also some open interest has got added, because there's a general feeling that let's do it around even at 18 rupees. Okay, they're willing to take the risk. So 39,500 is around 95 rupees, and you want to express that opinion. Probably you can just sell at 39,500 now at 95, and probably you can just buy back 39,300. So for the same 200 rupees, you can give 34 rupees or 35 rupees. Same thing like Nifty. So you can do for a 200 rupees risk, you get some 35 rupees here, and you pay the margin. Okay, so which is 3% exposure margin plus the difference of 200 into 25, just 5,000 rupees or so. So it's still much more comfortable for you, rather than to express a opinion by just selling a put. So based on this, we are clear from the open interest, the 39,500 looks to be a place where there seems to be some hesitation as far as the market is concerned, where probably it is expecting that the chances, even if it goes down, it will come back above that. And if you want to be literally safe, then you should even take 39,000. That is, 39,000 is going at 35 rupees, because normally now represents 2 times the standard deviation now from the option premium that is expressed. So you can go for a 39,000, which is 35, and probably you can 35, very unlikely area where it will be broken. So you can just sell 39,000 put. But again, the fear factor will be there, margin problems will be there. So you have to just sell the 39,000, But the problem that comes here is, if you try to buy anything below that, then the amount of money that you get will be quite paltry. 39,000, then you have to just go for 38,700 or 38,500 as a buy in order to ensure that your margins are not taken off. But then that will be quite a big spread. So instead of that, I think you should look towards taking 39,500 sell and buy at 39,300 and earn something like 32, 33 rupees, because that itself is a highly unlikely place, because there will be only 10-15% chance that probably it can be below that particular level. So that's how you take a credit put spread also. That is, you first analyze the open interest position. You look at the sum of the call and put price near the futures price which is there. Then subtract that or add that. So on the call side you get a strike, on the put side you get a strike. That really becomes a safer zone. Okay. So then you go for a sell put there or a sell call above this. Since the market is in a bullish mode, avoid sell calls. Then you go for a sell put. But sell put again is a dangerous thing in terms of risk and also in terms of margin money that may be required. So what you do is that you just do a spell put spread. So you earn a credit. Okay. So that is what you call as a put spread with some credit. Okay. So this is how the open interest, cut in open interest, as well as the selection of strikes for a credit put spread is done. So now it's 7:45. You can ask your questions. Thank you very much. So thanks for your participation. We'll see you after Diwali. So happy Diwali. Stay safe. Thank you very much.